So let's talk about put options. I know, the name itself can sound a little intimidating, right? But what if I told you the main idea is something you probably already understand? Something you might even deal with every single year. We're going to break this whole thing down by connecting it to a concept you already know.
Okay, just think about this for a second. When you have something really valuable, like your car, how do you protect it from a worst-case scenario? You get insurance, right? It's that simple. Just hold on to that very simple, very powerful idea. All right, you've got that idea locked in? Good. Now let's just swap out the car for something else. What about your financial assets, like your stocks? They can also lose value, and sometimes they can lose a lot of value. So, is there a way to insure them against a big price drop? Well, the answer is absolutely yes.
So let's really dig into this by building from the ground up, using that car insurance analogy. Seriously, by understanding the simple parts of your auto policy, you're going to see that you've basically got the fundamentals of options down already.
Okay, so picture this. You've got a beautiful car. It's worth $100,000. It's a huge asset, right? And the last thing you want is for it to get wrecked in an accident and lose all that value. So what do? Well, you go to an insurance company and you pay them a fee for a policy. We call that fee the premium. In our example, let's just say it's $3,000 for a year of coverage. That's the price you pay for peace of mind. And what do you get for that $3,000? You get coverage. Now, the insurance company is the one on the hook. They're promising to cover any damages, maybe even up to the car's full value of $100,000. And let's say the worst happens. Bam, you get into an accident. Maybe there's $20,000 in damage. You file a claim, and guess what? The insurance company pays it. You just spent a relatively small fee to avoid a massive financial hit. It's a simple but really powerful concept. Okay, so we've got the insurance model down pat, right? The owner, the insurer, the premium, the claim, we get it. Now for the fun part. Let's take that exact structure and just drop it right into the world of finance. In this slide, this is where it all clicks. Look at this. It's practically a direct translation. Your car, that's now what we call an underlying asset, like a stock. The insurance company, they're the option writer. The premium is still a premium. And the damage you're insuring against is simply a drop in the asset's price. It's the exact same framework, just with new labels. All right, so now we're ready to actually decode the key terminology. But as we go through each of these new words, just keep that car insurance comparison front and center in your mind. It is the secret key that unlocks everything here. So, first up, the put option itself. What is it? It's a contract, and it gives the person who owns it the right, and this is super important, not the obligation, to sell an asset at a price you both agreed on beforehand. It's basically your right to file that insurance claim if you need it. And the underlying asset, that's just a fancy term for the thing you're insuring. So instead of your car, it could be shares in some tech company, or an entire stock market index, or even a commodity like oil. It's just whatever you're trying to protect from a fall in value. So, who's selling you this financial insurance? That's the option writer. You can think of them as the insurance company in this whole scenario. They're the ones who collect your premium, and in exchange, they take on the risk that the price might go down. The option premium, well, that's just the price tag on the contract. It's your insurance payment. And just like with car insurance, the cost depends on the risk. So if the asset is super volatile, or you want protection for a really long time, you guessed it, the premium is going to be higher. Okay, so you've paid your premium. You've got your financial protection all set up. Now what? What can actually happen? Well, for you, the person who bought the put option, it really just boils down to two simple outcomes. So think of this as two paths you can go down. On the left, the accident happens. The asset's price drops. Your insurance totally pays off. Your option is now valuable because it gives you the right to sell at a price that's way better than the current market price. And the more the price falls, the more valuable your insurance policy gets. Now look at the right side. This is the no accident scenario. The price stays the same, or maybe it even goes up. In that case, you just didn't need the insurance. The option simply expires, and the only thing you're out is the premium you paid. That's it. And this right here, this is probably the single most important thing to remember if you're the buyer. Your risk is completely defined the second you buy that option. The absolute most you can ever lose is the premium you paid. Full stop. Your downside is capped. It doesn't matter what happens in the market. Okay, let's wrap this all up and get to the key takeaway. What have we really learned here about the price of protection? At the end of the day, it's this simple. A put option is just like buying insurance, but for a financial asset. Its whole job is to protect you against a price drop. You, the option buyer, pay a premium for that protection. And the option writer? They're the insurance company collecting that premium. And the best part? For the buyer, your potential loss is always capped at what you paid for that premium. When you look at it that way, all that complexity just kind of melts away, doesn't it? Which really brings us right back to that fundamental question. Whether we're talking about your car or your stock portfolio, the choice is always the same, isn't it? Is paying a small, known price for protection worth it to you? That's really the heart of what a put option is all about. In options trading, the strike price. So let's break it all down, shall we? Let me ask you a question. You insure your car against an accident, right? Of course you do. Well, what if I told you that you could do basically the same thing for your stock investments? Because that's pretty much what a put option is. It acts just like an insurance policy, protecting you financially if a stock you own starts to take a nosedive. It's an incredibly powerful way to manage your risk. Okay, so just like with any insurance, you have to choose your level of coverage. And in the world of options, that coverage, it's all defined by one single critical number. And that, my friends, is the strike price. So what is it? The strike price is the pre-agreed price where you get to exercise your option. Really, think of it as the trigger point. It's the exact stock price where your insurance kicks in and starts to do its job. Theory is great, but let's make this real. Let's walk through an example. We'll use a hypothetical scenario with Teva stock to see how this actually works. Okay, so picture this. Teva stock is trading right now on the market for exactly $20 a share. You own some, but you're getting a little nervous that the price might drop soon, so you want to protect your investment. You decide to buy a put option, your insurance policy. But now you have a choice to make. At what price do you want that protection to start? Where are you going to set that trigger? So here are your two main choices on the table. On one hand, you can pick a strike price of $19. Now, this gives you really high protection since it's super close to the current price, but that insurance premium is going to cost you $1 per share. Or you could set the strike price way down at $15. This is a lot cheaper, only 50 cents, but the stock has to fall a whole lot further before your protection actually kicks in. And this just lays out that fundamental trade-off perfectly. See, choosing that $19 strike means your protection starts almost immediately if the stock even just dips a little. But that security, well, it comes at a higher price. The $15 strike gives you less immediate protection, but it costs you half as much. So you might be asking yourself, why is one option so much more expensive than the other? Well, the logic behind the pricing is actually pretty intuitive when you think about it. It all comes down to one thing: probability. The price of the option, which by the way is called the premium, is directly tied to how likely it is that the stock will actually hit that strike price. Just think about it. What's more likely? That a $20 stock will drop $1 to $19, or that it'll plummet all the way down to $15? The smaller drop is way more probable, right? So because a huge drop to $15 is less likely, the insurance against it is cheaper. And that's exactly why that option only costs 50 cents. Now here's where things get really fascinating. What if you chose a strike price that's actually above the current stock price? Let's say you pick a strike of $24 for our $20 Teva stock. Can you even do that? Oh yeah, absolutely. But an option like this would be a lot more expensive. And why is that? Well, because the stock at $20 is already below the $24 strike price. Your insurance is already in effect. It has what we call built-in or intrinsic value. You're basically buying an insurance policy that's already paying out. And yeah, that's going to cost you a whole lot more. So what's the final takeaway here? Choosing a strike price is always a strategic decision. It's this calculated balance between the security you want and the cost you're willing to pay for it. So let's do a super quick recap. Remember, the strike price is your chosen level of protection. It's the trigger for your insurance. If the strike is closer to the current price, you get more protection, but it's more expensive. If it's further away, it's cheaper, but you have less protection. It really all boils down to that classic trade-off: security versus cost. And that really leaves us with a final question for you to think about. This isn't just about numbers on a screen. It's about your personal strategy and your comfort level with risk. So when it comes to protecting your investments, what price are you willing to pay for peace of mind? So, picture this. You own stock in a company you really believe in, but you've got that nagging feeling, that nervousness that the market could take a nosedive. How do you protect yourself? It's a question every single investor asks, and believe it or not, a put option is a really powerful answer. All right, here's our game plan. We're going to break this down into 4 simple parts. First, we'll talk about why options are basically like insurance for your stocks. Then, we'll get into the payout, that's the strike price. After that, we'll talk about the ticking clock, which is the expiration date. And finally, we'll put it all together to see how the price of this protection is actually figured out.
Okay, so let's start with the big idea. Let's just forget all the complicated Wall Street jargon for a minute. At its heart, you should think of a put option as a simple solution to that problem we just talked about, protecting your hard-earned investment.
Now, okay, that's the textbook definition. A bit dry, right? But what does it really mean for you? Well, the easiest way to think about it is as an insurance policy for your stock. You're paying a small fee, that's called a premium, to protect yourself if the price drops. It gives you the right to sell, but here's the key. You're not forced to. You're in control.
To make this all super clear, we're going to stick with one example the whole way through. Let's imagine you own shares of Teva, and right now the stock is trading at exactly $20 a share. Just keep that $20 number in your head as we go.
So if a put option is our insurance policy, the next logical question is, what actually makes it pay out? And that brings us to our first really key term, the strike price. The strike price is basically the price you get to lock in. It's the price you have the right to sell your Teva stock for, and it doesn't matter how low the actual market price might fall. In our insurance analogy, this is the exact value you're insuring your stock for. And this is where the strategy really starts to come in. So you can choose from a whole bunch of different strike prices, and your choice directly impacts how much that insurance policy is going to cost you. So how does that work? Let's just walk through this table. Remember, our stock is at $20. Now, if you pick a $25 strike price, you're getting the right to sell your stock for $5 more than it's worth right now. That's a great deal, right? It's called being in the money. And because it has immediate built-in value, it's the most expensive option here, let's say $7. A $22 strike is also in the money, but a little less so the cost comes down to maybe $2.80. But now what if you choose an $18 strike? Well, that's out of the money. That means the stock actually has to fall before your protection even starts. And because that protection isn't a sure thing, the cost is way, way lower, maybe just 60 cents. The bottom line is simple. The more valuable the protection you want, the more you're going to pay for it.
Okay, awesome. So we've set our payout level with the strike price. But, and this is a big but, just like your car insurance, this protection doesn't last forever. That brings us to our second key component, the expiration date.
Yep, it's pretty much exactly what it sounds like. This is the final day your contract is valid. If you haven't used your right to sell your stock by this date, the option just, well, it expires. It vanishes and your coverage is over. And the trade-off here is really simple to grasp. An option that expires in a year gives the stock way more time to potentially drop than one that expires in just 2 months. More time means more uncertainty and a higher chance of something happening, which makes that long-term protection more valuable and, you guessed it, more expensive. All right, let's tie this all together now. We've looked at the payout trigger, that's our strike price, and we've looked at the time limit, the expiration date. These 2 things are really the main drivers behind how much an option is going to cost. And this all boils down to 2 golden rules of pricing put options. Rule number 1, the higher your strike price is, the more that option is going to cost. You're simply paying for better protection. And rule number 2, the farther out the expiration date is, the more that option is going to cost. You're paying for more time on the clock. So ultimately, it's all just a balancing act. Choosing a put option is about finding that sweet spot, the right mix of coverage and costs that works for your personal strategy. You're constantly weighing how much protection you think you need versus how long you think you'll need it. So the question I'll leave you with is this. When you think about your own investments, where do you draw that line? What's the right balance for you between the cost of that protection and the amount of risk you're willing to handle? That right there is the strategic decision every single investor has to make. Thanks for joining us.
Hey, Here's our game plan. We'll kick things off with the core problem investors face, then we'll really dig into what a put option is. After that, we're going to walk through a real-world case study, using Nvidia, run the numbers, and finally, weigh the all-important risk versus reward.
So first up, the investor's dilemma. It's a simple but tough challenge. What do you do when you have a bearish outlook? That strong belief that a stock's price is headed for a fall.
Let's make this really concrete. Just imagine you're looking at a high flyer like Nvidia. I mean, it's had an incredible run, right? But your analysis is telling you that sometime in the next year or so, a pretty big drop is coming. That's the exact problem we're trying to solve here. So, how do you solve it? Well, let's introduce the specific tool designed for this very situation. It's called the put option. So, what in the world is a put option? At its heart, it's a contract. It gives you the right to sell a stock at a set price by a certain date. Now, the magic words here are right, but not the obligation. You aren't forced to do anything. You're basically buying the choice to sell at a high price, hoping the actual market price falls way below it. A great way to think about this is like buying insurance on the stock's value. You pay a small fee, called a premium, for protection. But here's the cool twist. We're not just trying to protect ourselves from a loss. We're actually trying to use this insurance to make money from the price drop itself.
Okay, every put option boils down to 3 core pieces you have to know. First, the strike price. That's the price you lock in. Second, the premium. That's what you pay to get the contract. And third, the expiration date. That's your deadline. Your entire theory has to play out before that clock runs out.
All right, theory is great, but let's see how this thing actually works in the real world. We're going to use a solid example with Nvidia straight from our source material.
Here are the numbers for our case study. So we're buying a put option on Nvidia that expires way out in March 2026. We pick a strike price of $160, and the cost, the premium, to buy this contract is $22 for each share. Remember these numbers, because we're about to put them to work. And now for the part everybody wants to see, the math. Using the numbers we just laid out, how do we figure out our potential profit or, our potential loss? Let's walk through it together.
Let's start with the best case scenario. Your prediction was dead on. By the time the expiration date rolls around, Nvidia's stock has crashed all the way down to $100 a share. So what's your profit look like?
The calculation is actually pretty simple. Just 3 steps. First, you take that strike price, $160, which is the price you have the right to sell at, then you subtract the real market price of $100. That gives you a gross profit of $60 per share. But hold on, we're not done yet. We have to factor in what we paid for it. And there it is. After you subtract that $22 premium, your net profit is $38 a share. Just think about that for a second. You more than doubled your initial investment, all because you were right about the stock going down.
But hey, trading is never just about the upside, right? What happens if you're wrong? We have to flip the coin and take a hard look at the risk involved with this strategy.
This is such a critical question. What if Nvidia doesn't fall? What if at that expiration date in March 2026, the stock is trading at 160 or even higher? You've got to understand your potential loss just as well as your potential gain. This breaks it all down beautifully. You've got 2 simple outcomes. If Nvidia's price is below your 160 strike price, your option has value. You get to sell at a higher price than the market, and boom, you make a profit. But if the price is above 160, well, your option is worthless. Why would you use your right to sell at 160 when you could just sell it for more on the market? You wouldn't. The option just expires.
And this is probably the most important part of managing your risk when you're buying puts. Your maximum loss is set in stone from day one. The absolute most you can ever lose is the $22 premium you paid. That's it. Your risk is defined, no matter how high the stock might go.
So let's just recap the big takeaways here. You buy a put option when you're bearish, when you think a stock is going to fall. If you're right, your profit potential can be huge, and maybe most importantly, your maximum loss is capped. You know exactly what it is the moment you make the trade. And that really leaves us with one final thought. We've seen that a put option is a clear-cut tool. The risk is defined, the potential reward is clear, the strategy itself is pretty straightforward. The really hard part, the real question this all comes down to is, can you predict the future? Is your forecast for the market the right one?
You ever get that feeling in your gut, that feeling that a stock you're watching, or maybe a crypto, is just way too high and it's about to take a nosedive? Well, today we're going to talk about a really powerful tool that's designed to let you act on that exact feeling and maybe even profit when things go south.
So picture this. You're looking at an asset. All the signs, all your research, everything is screaming that a price drop is coming. You're just convinced it's overvalued and a correction is right around the corner. The big question is, what do you do about it?
Well, it turns out the financial world has a specific instrument built for this very situation. It's a way to not just, protect yourself from a loss, but to actually position yourself to make money from that market decline.
And that tool is called a put option. So let's pull back the curtain and really break down what it is and, more importantly, how it actually works. This way, you can see if it might be a good fit for your own strategy. Okay, so what is a put option? The easiest way to think about it is like an insurance policy or maybe like a price reservation for selling something. You pay a little bit of money up front, and that fee gives you the right to sell an asset at a locked-in price. That's the strike price, sometime before a specific date. And the keywords here are right, not obligation. It's totally your choice whether you use it or not.
So, with every option, there are two sides to the coin. You have the buyer, who we often call a bear because they're betting the price is going to fall. And on the other side, you have the seller, the bull, who's betting that the price will actually go up, or at the very least stay flat. See, the seller is hoping your prediction is wrong, so your option becomes worthless, and they just get to keep the fee you paid them. All right, theory is great and all, but let's see how this actually plays out in the real world. To make it concrete, we're going to walk through a case study using a really popular asset, Bitcoin.
Okay, let's set the stage for our scenario. Let's say Bitcoin is currently trading at $111. But you think it's headed for a big drop, all the way down to $50, sometime before December 2026. So you decide to buy a put option with an $80 strike price. What this means is you now have the right to sell Bitcoin for $80, no matter how low the market price goes. And for that right, you pay a small fee, which we call a premium, of $11.
Okay, so we've paid our $11 premium. We're holding the contract. Now for the fun part. Let's crunch the numbers and see what happens if our bearish prediction actually comes true.
Let's fast forward to the expiration date, and boom, you were right on the money. The price of Bitcoin has cratered, dropping all the way to $50. Now that option you have to sell at $80 is suddenly very valuable. In trader speak, we'd say it's in the money. So how do we figure out the actual profit? It's pretty straightforward. First, you exercise your right to sell at your locked-in strike price of $80, even though anyone else has to sell at the market price of $50. Right there, that creates a gross gain of $30. But of course, we have to account for our initial cost, so we subtract the $11 premium we paid, and that leaves us with a final net profit of $19.
And this, right here, is where the real power of options becomes so clear. A $19 profit on an $11 investment. That's a 172% return. You've successfully used a market downturn to your advantage with a pretty small initial investment, and you didn't have to do anything complicated like short selling the asset itself.
Now, that's obviously the best case scenario. That's the home run. But let's be realistic. What if you're wrong? What happens if the price of Bitcoin doesn't fall? What if it stays the same, or heck, what if it goes even higher?
And this is honestly one of the biggest advantages of buying options. Your risk, your maximum loss, is strictly limited to the premium you paid. In our case, that's just $11. That's it. Unlike other strategies where your losses could be huge, with a put option, you know your absolute worst-case scenario from the second you make the trade. If Bitcoin stays above $80, your option just expires worthless, and all you've lost is that initial $11 premium.
So let's zoom out and recap the main points here. When you're thinking about put options, what are the really crucial things to remember from all this?
So, to put it in a nutshell, why would you buy a put option? Well, first, you're bearish. You think an asset's price is going down and you want to profit from it. Or maybe you already own that asset and you want to protect your holdings from a drop in value. That's called hedging. The huge advantage is that your loss is capped at what you paid, but your profit potential can be massive. And remember, this isn't just for crypto. This strategy works for stocks, commodities, you name it.
So now you've got a new tool in your financial toolbox, one specifically for when you think the market is headed down. The question is, how might you use it to navigate the inevitable ups and downs? And more importantly, what will you explore next to become an even sharper investor?